Good morning, future millionaires, to the Get Rich Slow podcast. I'm Rob Delavan, your host. I'm joined by Lance Johnson, also your host, and a special guest today, Sue Yort. We are on episode 5 in an 8-part series. Our title today is Making Standard Deductions versus Itemized Deductions Simple for You. And welcome back. Lance, will you share a quick success story of some work that you and Sue have been doing together?
Oh yeah, so I got a good one. So this year we really embraced year-end tax planning. And so this year, instead of financial planning clients, we kind of opened it up to some of the tax clients. And you could tell that they were starving for it. By sitting down with them and almost planning out their taxes, not during tax season when Sue is, like a zombie because she's
zombie
sleep deprived. We have the time to look at the situation and provide alternates. And Sue just did a great job of helping us through the financial and tax side, coming up with a game plan so that when these clients actually did their tax return, it was a moot point. We were able to maximize in the year and reduce their taxes, but then be able to make sure that the withholdings were matched up so that they had a slight refund. And so then when they do their taxes, it was kind of a formality of compliance, not necessarily a surprise to them. And I kind of felt like they felt the gratitude of dealing with that then. And then also what changes we made at the end of the year, we were then able to implement in January for the next year, instead of June, July, August, where you're getting crushed with cash flow. Right. And I just thought Sue did a great job, and I felt like the clients really appreciated it.
That's awesome. I love the success. We're making wins for our clients and our future millionaires, right?
There you go.
That's great.
Love it.
Nice job, Sue.
Thank you.
Upcoming events. We're gonna link to our calendar in the show notes, and we have the whole year of 2022 mapped out. So looking forward to a productive year of getting together with people again post-pandemic. And our appropriate websites, we got roi-financial.com. We have roi-tax.com for Sue. Mine is delavan-realty.com on my side. And Adrian, who is in Hawaii, normally one of our hosts, is hopefully he's enjoyed himself. I think he went to a luau yesterday, and he's with directorsmortgage.com. That'll also all be in the show notes. So our episode today, we're going to be picking Sue's brain and Lance's on the tax and financial side. And she'll be teaching us how to make standard deductions versus itemized deductions simple. This is part 5 again in an 8-part series. And just to recap our last episode, we learned some basics when it comes to small business taxes. Sue, thank you again for being here. We always treasure the time during tax season that we get a little droplets of Sue's wisdom for us. So, warm welcome. You are our trusted CPA. And we appreciate you being here for this series.
Thank you.
So we're excited to learn some basics about deductions, itemized versus standard, trying to make it simple, and we'll explore a few questions here. So number 1, is there a simple place to find a list of itemized deductions for the state of Oregon? And I know you guys will talk about the Fed side also. And of course, a lot of our listeners are in other states. We just happen to be in the state of Oregon. So
what I've learned from my education that we talked about in some other episodes too, was that 90% of people now are doing the standard deduction because after the 2008 bill, they doubled it. And so
the 18 one, right?
Yes, what did I
Yes.
say? 2018.
Oh, yeah. Okay. Got
Okay,
it.
maybe I used the wrong number. I apologize. So yes, after that tax bill, they doubled it. Married couple is up to around 25,100.
Mhm.
And single is about 12,550.
Mhm.
So there's a lot of people who don't itemize. However, I encourage people, one, your state may be able to use itemized deductions,
Okay.
which is why we're asking about Oregon, because the state deduction standard for Oregon is really low. It's like 2,300 for single and 40, 600 for
Okay.
married.
Mhm.
So plenty of people are able to itemize just by property taxes and donations, or property taxes and mortgage interest. So that at least I would encourage. But we've given you a couple places to look at what you can itemize, and I'll talk some more about it. But there's an Oregon.gov reference link that we'll
Okay.
have in here. And then I have a exhaustive kind of list that I use when people come in with unusual things that they want to deduct. And so it's like 3 pages, and I'll scan and put that into the notes of this as well.
Okay. So the follow-up question to this, Sue, is what can I write off as an individual? And I'd love to hear maybe an example or two of some kind of weird things.
Oh, I've got them. Okay. So the basics are, if you own a home, you've got real estate property taxes.
Sure.
And if you also have a loan on that home, then mortgage interest. And then the final would be charitable donations, whether it's cash or non-cash, which is like the Goodwills, the Salvation Armies, stuff like that.
Okay.
Now, there's also medical. Medical is a little harder because they put some boundaries on it. So in order to deduct medical expenses, they have to be more than 7.5% of your adjusted gross income. So as an example, if you had $100,000 in adjusted gross income on your tax return, then you would have to have more than $7,500 of medical expenses to make it start counting. So that's my easy example I tell people. They did away with miscellaneous deductions, which with that 2018 tax bill. And so that's where we had things like W-2 workers who could do office in home, or business type expenses, legal fees and CPA fees and financial advisor fees. Those were all in that miscellaneous section. And that's where I got some unusual ones. Although in the medical section, way back, I had someone with their hot tub, and there was a doctor note. So they were able to deduct their hot tub, and it was never audited. So it went through. After that, they got rid of that deduction. Okay, then I had someone write off a therapy dog. That was under miscellaneous deductions, not medical, because she brought it to school to work with her middle schoolers. And so it was a legitimate business expense that you could back then write off in miscellaneous deductions.
Interesting.
The dog, its feed, its vet bills, but can't do that anymore. Don't anyone do that.
Yeah.
Just there have been a few over the years.
But there's some along those lines. There are some discussions we'll have with clients where they have choices to do PPO and the HSAs. And so HSAs can, you put money in pre-tax, it grows tax deferred, but if used for medical, it's tax-free, right? Well, a chiropractor and massage therapists are part of that list, where normally they wouldn't be. But a lot of people don't know this is if you get let's say you get injured and your doctor writes a note that you need to rehabilitate, then your gym can actually, your gym dues can be put on an HSA.
Interesting.
And so, again, check with the CPA and so forth, make sure you get the notes. But those are all part of the, is that possible to do that? The answer is yes, it's possible, but you want to make sure that you have the right proper documentation in your file so that if you get audited, you're using that HSA, which is tax-free for, your membership dues.
Yeah, that's the key, is to have the health savings plan, what he's referring to, HSA, because it wouldn't be deductible on itemized deductions if your income was too high. But if you have the health savings plan, you could put it against those costs. So yes, that is good, Lance.
Well, circle.
So what we would try to do is, the conversation starts with the client is, I remember back in 2017, I was able to do this, and the world has changed. Right. And then it's like, well, you're right, you can't do that. But during open enrollment, if we were doing year-end tax planning, and you notice that the person never really goes to the doctor because they're healthy, but they do use, acupuncture or massage therapist, or maybe they did get injured or whatever, rehabilitating, they might switch to an HSA, max fund it, which brings down their taxes. And now you're setting them up for next year, which has to be, you have to do that enrollment during October to November of this year. Right. And so, those are useful discussions with Sue that started with itemized, but led to a different direction.
There you go. That's correct.
No.
Interesting.
No.
So now we start getting to a little more interesting or a little more complex pieces. What can I write off as a business owner?
Okay, so that's different than itemized deductions, because as a business owner, you're gonna you're gonna deduct things against your business, which kind of goes to that small business conversation. But as a overall, it's anything that you use to further your business, everything from marketing and promotions to the basic office supplies. And, I mean, the ones that people always ask about are things like, company parties or things like that, which, yes, you can do that. It's employee, appreciation and development and things like that. So, yeah, that is a wide list of things that you can deduct as a business owner.
But maybe Sue, one of the things we could touch upon that's an itemized is, I use an example, is a business owner, small business, we always run into issues of them getting their bookkeeping done. And part of it is, you got bookkeeping on the business side, and then there's bookkeeping on the personal side. So example is, I have a home office, and in that home office, I see clients, and I have, I have a bathroom, and I have to get to the office. What can I write off? And so a lot of people are confused what they can write off. And some of these things show up on the itemized list, like interest deduction and property taxes. But then a portion of their business is out of their house, square footage wise, and some of their utilities and property and insurance that are normally not written off or written off on the itemized. We have to educate them about, okay, now a portion's on the business, so it doesn't show up on the itemized, things like that. And then when you start to take those and put them over here, now all of a sudden your charitable contributions are not written off because, and so there's a lot of, I'm going to call it, lack of better words, cause and effect relationship between itemized and business. And then I think, Sue, what I would probably have you do is just talk about the benefits of getting those write-offs further up the tax return than on the itemized list, and what the benefit versus business owner.
Well, to go back to the original statement, is 90% of the people are using standard deduction. So I think what Lance is referring to is, hey, if you're using standard deduction on your personal, maybe your mortgage is low and, you don't have the charitable or something. So you're using that 25,000. Let's move some of it over to the business so we can take advantage of it there. And that's where you're talking about your office and home and things like that, where if you're doing a LLC and you're doing office and home then we are going to have portions of mortgage interest and property taxes, as well as a percentage of those utilities that go into the office and home. And then you're taking better advantage of it rather than where you're using standard deduction and can't use it on a Schedule A.
Yeah.
Go ahead.
And it's a big missed opportunity. I mean, in these small business owners, I'll just say that the ones between $0 and say $300,000 of gross income, maybe not necessarily net income, but just those beginning, they're on their way up to building a more than a mom and pop shop. We just see them trying to do stuff their own in, different programs that are online. And what we know is you don't know what to click or what's after that click on TurboTax or H&R Block or whatever. And so you don't know what you know. And so then you miss the opportunity of things that you could write off or position better on the tax return. There's missed opportunities, and we see it all the time.
Okay, so the last question I have for the two of you is, how do I calculate charitable donations? What's the best way to do that?
Okay. So, donations, like I said, fall into a couple categories. The cash that you're just here, I want to give money to church, scouts, whatever it is, and the non-cash, the Goodwills and I cleaned out my house and that type of thing.
Okay.
So cash is straightforward. Anything over $250, have a receipt. And most people, even those $25 one-offs, if you've got them, you've got an email receipt. Okay, pretty straightforward. Now, it's where the non-cash gets a little gray. So up to $500, you don't need too much documentation. They aren't requiring such, but over $500, you need a receipt from Goodwill where you've detailed or you've taken pictures or that type of thing. And according to the instructions, if it's over $5,000 of non-cash items, then you need an appraisal. So I kind of tend to tell people, hey, I cleaned up my house, it's got to be $10,000. I said, we're going to back off a little on that. However, I have learned a few things and done a little research that it could be over 5,000 if you divide it into types of items. So clothing, it could be a category. Household furniture could be a category. Other types of tools could be a category. You cleaned out the garage, but again, you need some really good documentation. So either a written list or pictures that you attach. And it, as long as you've got it, that's the important thing. I will say as well, other people donate stock, like to their church, because the reason being is they can donate stock. It is a donation at a fair market value. Their church gives them a receipt and says, you donated these 600 shares of IBM on March 25th, 21. And you can use the fair market value as the deduction. However, you maybe bought that IBM at $2 a share or something. So you don't have to pay the capital gain, but you get the full deduction. So, and because there is a fair market value that's online, that's everywhere that you can see, it can be well over 5,000, for stock. Okay. There's some other things people do. They want to donate, they want to make a big donation, but they don't know where. So you can put it into something like Fidelity has a fund. You put it into a fund, it sits there in your name. You get to deduct whatever it is, 25,000 in 1 year. And then in later years, you tell them, where you want it to be donated out to.
Hmm.
So you get the current deduction, but you get to assign where it goes to later.
Oh.
So yeah, there's a lot to charitable donations. And to back up to, well, yeah, but I'm using standard deduction. Okay, so with that, I've seen people do 1 year on, 1 year off. They do a big deduction, they double their deductions in 1 year so they can itemize. And then maybe the next year they won't do the big deductions. So, I mean, the big charity donations, excuse me. So,
yeah. So if I can interject on that. So
absolutely.
So reiterating with her, there's just basic concepts. So there's compliance of itemized versus charitable. So obviously sometimes you're in a standard, but this year, I think if cash donations are $600 and you're at the standard deduction, you still can take $600 and write it off against the tax return above, because it was cash donations versus a goodwill.
Yes, that is correct, Lance, for this year. And
Yeah.
that's in addition to your standard deduction.
Right.
If you had cash donations 600 or more, they let you throw that in.
Okay.
On the front page.
Then there's kind of what I call best place practices type stuff. So she alluded to it is, if you are going to donate, a couple things you want to do is instead of bring a big trailer one day, dump it all off one day. All right, a couple things you'd want to do: snap a picture, right? Itemize the list. Or what I would tell you to do is make multiple donations throughout the year and categorize them with pictures and an itemized list. And then you can use a program called It's Deductible for some of the basic stuff. And you'll be surprised on how much a bag of clothes adds up when you go to that and you realize I would have never put that in. But it's a program that the government and
TurboTax
worked out to have a fair. So you got a picture, you got multiple donation slips, you got an itemized list, and you use an It's Deductible. That's a program that's being used. I'm not saying you're bulletproof. I'm just saying you've done the best place practices of documenting your stuff.
Right.
Okay. Then what she talked about is what we call tax bunching. So every other year, you bunch your charitable, especially maybe if you had huge medical, maybe it's a year that your income is low. So some of those things are, the medical is more deductible, and you can put them into, it's not a charitable remainder trust, but like we use, it's a charitable donation funds where you can put 50,000 into one, put it in the program, manage it yourself. So, like my brother-in-law did that a couple of years ago, put $150,000 into it. It's grown to 200-something thousand, but he can then just dole out money, but he got the write-off, whereas every year he wouldn't get the write-off because of the full write-off because of standard deduction. Wow. So there's a strategy with clients where we tax bunch in particular years. And it depends on medical, depends on income, depends on your charitable content. And then I agree with Sue, anything over $300 going to a routine organization, we can draft a letter. My clients never use cash. Cash is king. So I agree with her. If you're going to put $2,400 to your church or $200 a month, I would tell you to talk to the pastor. And what we would do is January, we would donate the most highly appreciated stock, okay, in your non-qualified, and say that's $2,400, and you would make that donation, but your cost basis might only be $200. And then at the end of the year, you're looking for next year. I would do the exact same thing for next year, but I wouldn't use your cash. I'd keep your cash. And that's kind of a best place practice. That's a long story, but those are some of the things that we talk to clients about is, are we bunching this year or next year? And how are we doing it?
Well, in the final thoughts here, I would say, obviously, I'm noticing a few trends. So number one, obviously, document, right?
There you go.
Document correctly. and you need advisement for that.
Yes.
And then number two, strategy is literally, let's make sure, and I guess you can't really document or do strategy without or make those strategic decisions without having things. You got to be ahead of it, right? So if we're going to make these decisions, we need to be making them in the probably summer and fall, so that it's this concept of you have to be ahead of the game. You can't be strategic unless you know where you're at, right? So I don't know, any other final thoughts between the two of you?
In order to do that strategy and plan ahead, you need good advisors. So, you know, tooting our own horn, you need a CPA and a financial planner. So just, you know, it helps when you're strategizing and doing the tax planning.
Okay.
Not only that, I think those two people need to communicate. So, you know, and not always does the CPA and the financial advisor, are they on the same page, nor do they communicate at the right times, right? So you're communicating to a client in tax season, I'm communicating clients in fourth quarter. Having those in the fourth quarter, I think, is a better, what I call best place practice.
Awesome. Okay. I love it. Well, thank you, Lance. Thank you, Sue, for adding such value to our listeners. Again, the best way to find Sue as our guest in this series is www.roi-tax.com. Again, that'll be linked below in the show notes. And stay tuned for the next episode in this 8-part series with Sue. In the next episode, we will be learning all about real estate and taxes. It's a fun one. Love it. All right. Thank you all for being here. Thank you all for listening. And we'll catch you on the flip side.